Everybody, it's Pete Carmasino here at Chaikin Analytics. Thanks for tuning in for this week's halftime show here on StockCharts TV. We missed the last couple of weeks, so I apologize for that. Just was traveling and some of the things got in the way. So a lot has happened since then. We're in a bit of a bear market rally here. It's been volatile. There's been some breakouts that might seem unusual. We're seeing financials turn the corner. We're seeing energy obviously reigniting to the upside, so to speak. But right now, just looking at the averages, it's pretty mixed. Everything's mostly higher here, but nothing standing out directly. And I think really the focus for this week, really, and for the rest of the year is selectiveness. Let's be very selective in the stocks that we're looking at, ones we're trying to take exposure to, and we want to also protect on the downside. So bear market rallies are a really hard environment to either invest or trade in. They're typically really good trading environments, but those particular trades may not last as long as you might see in a bull market. Now, there's been some stocks that have done extremely well this year. Some healthcare names, some energy names, of course, and there have been other names that have just not rebounded at all. Technology, communications, discretionary. They've had very volatile areas, but we were really against the trend. We were bearish on technology, communications, and discretionary really from the beginning of the year. And in some cases, I believe XLC, we were bearish for a full year now. So the point being is that when trends start to develop and sort of reveal themselves, they tend to last longer than most people think. So you got to be very careful. You got to be very selective in this market. You have to be a little bit more nimble than typical, but also don't sort of be leaning too bearish or too bullish, right? You got to be very, very balanced in these kind of things. And so, when you're seeing breakouts happen, like I'll look at JP Morgan today, which has had an incredible change of trend. And in XLF in general, the sector itself is also showing that. So when you start to see sectors change, you go and look at the best names in those sectors, and you start to maybe take positions in them. That's a top-down analysis. And so we'll go over a few sectors today. I want to look at some individual names, and we'll talk about TLT, the fixed income, which I called out as a target of 97 months ago, and has really gone below that, hit around 93, 92 as well. But it looks like it might have some further downside in that specific fixed income instrument. So let's take a look at the charts and see what we're seeing today. Okay, we're back here on the ACP platform, and I'm just going to go through the sectors very quickly. So, obviously energy is in great shape. We were really bullish on this name from the beginning of the year, and I want to call something out. We used that $50 to $52 level as resistance, and obviously that became support at some point. We know from technical analysis that that's how those levels work. This one was really textbook. And we were very bullish on energy really through 2001. It was a pretty choppy kind of rally, then pulled back. And it's doing that again. We had a big rally up until the June timeframe. Then we sold off, and now it's reemerging again. And that's what I said earlier on here in the video, that I think it's just reemerging now. We're starting to see some names do very, very well. As I said, financials are starting to break out. Now, this trend has yet to really facilitate itself inside the actual sector ETF of XLF. But when you look at the XLF relative to the SPY, the SPY, the S&P 500 ETF, you see a change in trend. Now, this has been a long time coming. I had written about this many, many times, that this is one of the most confusing setups because rates are rising so high. You would have automatically thought that this sector would have done extremely well. But when you're talking about recessions, when you're talking about slowdowns, there's a push and pull on this sector, and it's not all positive. So it's starting to reveal itself, but it's really not after some major drawdowns have occurred. And so when you start to see that, that's when you can maybe start to take some positions. And again, I say maybe, but we're going to look at JP Morgan. That one's really breaking out and looking great. XLI, the industrial sector. Now, I had been bullish on this really middle of the year, so to speak. Beginning of the year was in a downtrend. You could see the sector ETF itself. It really hasn't fully recovered, but when you compare it to the SPY, it's done very well. And really just recently, this relative outperformance is significant, and you're seeing some names that are starting to perk up. We talked about XLC and XLY. XLC has just been a disaster now for a full year. We were negative on it really around this time frame last year, right? Almost the exact same weeks we were talking about it, and obviously started to break down and just continue. This is a trend that got out of control and no one was really expecting. There are people now apologizing for not calling this out earlier, while we are kind of basking in the sun a little bit. Unfortunately, a negative call, but the point being is if you can avoid drawdowns like this, this is part of trend following, recognizing the environment that you're in. A rising rate environment is going to hurt tech stocks and really do better for value stocks. And speaking of value, look at XLP, which has done relatively well to, when you versus the S&P on the ratio that you can see here. But really, on an absolute basis, it really hasn't done very much for the year. But that's the point. It acted defensive. Okay. So when you put your defense on the field, they don't always score, but they prevent the other team from scoring most of the time. You hope. And that's really what this was. You prevented the drawdowns in your portfolio if you migrated to the more defensive sectors during the year. That's the point of being defensive in a bear market. Okay. So let's go look at one other thing here, just the rallies that I've been seeing here. And I like to count these out on a weekly basis. And I was using bullish percent for many months. We saw this chart over and over and over again. Go back and watch the replays. We talked about rally 1, 2, and 3. I was looking for rally 4. We finally got it. And that really started about a month ago, right? October 10th, October 11th, that week. Okay. And that was the week we saw Netflix report. And we started to see a bit of a trend change and just the overall makeup of what people were expecting. October is called the bear killer in general, and blah, blah, blah. We've read about that a million times. But I'm not necessarily sure that this is a bottom rally. In other words, that we found the bottom, right? No one really knows that for sure. But I think we're still in a bear market. And you can start to take positions, but, to use an old phrase, you can go to the party, but dance close to the door. You want to put your stops in areas where you're being protective, you're being defensive, you're not being too aggressive. As I said, stay balanced, don't get too bullish, don't get too bearish, okay? But looking at the S&P, I think we're in rally 4, but I think it stalls around this level, this 3,900 to 4,000 level, and it's really not even gotten that close to it. I think the high was roughly right around 39.05. That was the week of the 24th and kind of stalled out. Now, I don't know if it's rolling over here. It certainly doesn't look like it's giving up yet. But again, we just don't know when it's going to happen. If it hits this top trend line again, we can maybe see 4,100, 44,000 to 4,100. But I wouldn't be banking on that. Could be very quick and it could be a turnaround. We got the election, we got CPI this week. I mean, we got a lot going on, so we got to be careful. Okay, let's get into some names here while I have you. One thing I wanted to point out was I encourage you to follow me on Twitter. We talk about things like Netflix, or I'll put some things out, anecdotal evidence about just some names like TLT, Netflix, Biogen we talked about early in August, and that turned out to be a pretty good trade. As I said, there are great trades that are happening in this market. They're just not sustainable. They're not continuing. You just got to be very careful. But on Netflix, we called that out on the week of October 17th, and it was only because it had relative performance versus its peers, the FANG Plus Index, the prior week, right? And when we were looking at the setup, we were seeing a neutral rating, and I understand that, but that's since turned bullish. And this was before earnings. It's it's not always the best trade setup. This one just looked like it had a lot of evidence that it was going to be a better report and there's going to be a positive move in the stock, and it turned out to be that way. So, if you follow me there, you'll just get some other things that you can look at. So let's just look at our list today very quickly. I've got just about 4 or 5 minutes left here, and I want to try to get through this quickly. So just seeing some names break out. When I look at our charts, and I'll really bounce between the ACP platform here and our charts as well. Here's a name like American Movil. You can see it's in the communications area. You can see where the stock has had really a drawdown, a double top up here, and then failed in May, and then rolled over. Now turning a corner a little bit, right? So if I go to AMX here on our system, right? I'm seeing a change in trend, and it is early. Okay, so when you see these changes and you start to break out, it's almost like a cup and handle. Not necessarily, we didn't put the handle in, so to speak, but that might form. Let it pull back a little bit. Maybe take a very small position up here, but use levels of like $18 as stop levels or alerts. And if it gets anywhere below that $16 level, then it probably starts to change trend. So that's just one name I wanted to call out. I talked about industrials. Here's a machinery name called Kennametal. Really interesting chart. Now, this one's interesting. It is very bullish, as you can see here. So our rating is updated, and it's doing well from a relative standpoint. But from an absolute standpoint for this year, it's been a pretty bad year for this stock chart if you owned it from January. Now, on our charts, you see negative relative strength. So you wouldn't want exposure to this kind of name. And if you did, you would want to reduce it for sure and wait for a trend change. Now, we had a big move higher. They missed earnings, but guidance wasn't bad. And you're getting maybe this oversold setup here. And it could be an opportunity. But, you would want to use the previous low as a stop area, about $20, right? So that's not far from where it is now. It's only $4 away. But if you start to migrate there and stay several days under that $20 level, you might have a negative change going on. So just be careful, okay? These aren't recommendations. These are just kind of call outs what we're seeing changing, right? CommVault, another one. Interesting looking name, right? Go take a look at that. We're bullish on the chart or on the rating. And if I look at the chart, CVLT, I got a pretty good setup here as well. It's very interesting. Earnings are already out. They beat estimates, so no more surprises, hopefully, from a name like this, as far as earnings go anyway. But you're getting that sort of relative strength change to the upside. It's starting to pull back a little bit. It's maybe settling in a little, be an awesome entry somewhere around that $60 to $61 level. And then, on the stop level, just look at those previous lows, right? That's a long way down, $50. So you may want to just reduce that to maybe 55 if you start to see things change, if the stock gets down that level and starts to really stay at that level or go lower for several days in a row. I would think that, we'll see a negative relative strength change there. So, okay, a couple more names here and then we got to go. Evercore is looking great. Really like the chart here. And so I'm going to pull up Evercore EVR here. Capital markets. Now, this could be tricky as well, but again, it is changing trend. It's got a nice dividend. It's a very firm company, and earnings aren't out until next year, really, the next earnings report. They already reported, but again, early relative strength changes. Now, again, these are early. These are aggressive, so just be aware of where your stop levels are. I always look at the previous lows. That would be a really long, heavy duty stop there at 82. So you may want to just up that and be a little bit more conservative around 95 or so. You start to take notice that if this is changing trend and potentially not going higher anymore, you got an issue. And the last one I just want to look at really quick is BKE. Just to name a specialty retailer that's also changing trend to the upside. Pulling back, you've got earnings coming out November 18th, so just be careful with that one as well. Okay, everybody, that's all we have for today. I really appreciate you tuning in. Make sure you leave your comments, give me a like on YouTube. I would really appreciate that. But follow me on Twitter as well. All right, we'll see you next week, and take care.